Well, China's been a big focus for investors this week after the country saw consumer prices tick lower for the first time in 2 years. President Biden calling China's growth concerns a ticking time bomb at a political fundraiser. Our next guest remains skeptical of some of the numbers we are getting out of that nation. Kenny Polcari, Kace Capital Advisors managing partner, is with us now. Kenny, it's great to see you. So what do we make of all of the China data and the China rhetoric and what it means for investors here in the U.S.?
Listen, I think you have to be very careful when you go into China because the rules can change from moment to moment, right? So you never really know what you're getting. They're telling us one day that the China economy is expanding. They tell you the next day China economy is declining. Then they tell you China's buying oil. Then they tell you China's not buying oil. And so they create all this chaos. So I actually do not invest directly into China just because I don't want to add that chaos to what else I'm doing. I have exposure to China through things like Apple. But therefore it's controlled by Apple, right? Not so much by what the Chinese want to do. So I tend to stay away, but that's me personally. There are people certainly that find opportunity in China, but I think you have to understand going in that it can be a very volatile investment part of your portfolio.
But even your Apple holdings would still be impacted by whether or not China decided to put more liquidity into the economy and into consumers' hands and their spending propensity as well, yeah?
Agreed. So therefore, I do have some exposure to China, but I like to think because I own Apple, it's really a U.S. company. While it may respond to what's going on in China, that's different than China being able to go in there and change the rules on Apple or change the way they can in Chinese listed companies, right? Where they can suddenly just decide, this isn't going to happen anymore. We're changing rules. They can't really do that to Apple. And by the way, even though Apple depends on China for a lot, they are starting to, and we've seen it ever since COVID, they are starting to broaden out their supplier base, whether it's Vietnam, whether it's India, other parts of Asia, so that they're becoming less dependent on what happens in China.
Kenny, I want to pivot, if we could, you mentioned oil in passing with reference to China. We just heard our Jared Blickery talking about it. You also have been writing about it in your morning notes. Oil's been creeping up. How much of an issue is that going? It hasn't seemed to be much of a problem for stocks, but will it be?
Well, oil stocks certainly have done well, right? With oil creeping up, it's up 25% just from 2.5 weeks ago when it was trading down at 65. It's now trading at $84. And likely probably going higher. We see that the production cuts by the Saudis and Russia are starting to take hold. We see global demand increasing. In fact, I put it in my note today that Bloomberg ran with an article about how global demand is robust. And actually, China's buying plenty of oil. So this whole idea, once again, about China, is kind of conflicting. But one way or the other, at some point, yes, if oil becomes way too expensive, is it going to hurt our economy and then therefore hurt the market? Potentially, yes. So I think you have to be careful going in, but that doesn't mean you should panic and start selling everything. It just means you need to take advantage of the opportunity that's going to create in other sectors of the market.
Is there any different way that investors should be playing kind of the international equation going into 2024? Now that we've essentially got a quarter and a half left in 2023, a lot of people are going to start paying attention to what is 2024, and that is a general election year here in the U.S.
Yeah, there's going to be a lot going on. I tend to in terms of international markets, I tend to favor European markets versus the other markets, versus the Asian markets, China, Hong Kong, any of that. My exposure is in international is in Europe. Now, I do think, and I like Europe, the UK has been underperforming this year. If you look at the list, the UK is only up 1% on the year, while all the other markets in that region are up double digits, right? From the Eurostoxx, Italy, Spain, Germany, France, they're all up 13 and 14%. The UK is lagging way behind. Now, part of that is the economy in the UK. I get it. Inflation is sticky. The BOE remains hawkish, the same way the Fed is going to remain over here. But I think you have to be selective, like anything. I don't think you can just passively go in and buy the market. I think you have to really look and find the sectors that you think, like here, are going to do better in a rising rate environment. Those would be names like consumer staple names for me, banks, and healthcare. Whether it's here or whether it's in Europe.
And what about the market overall here? Because as you've been rating recently, maybe the market's a little tired. We've seen evidence of that over the past couple of weeks. We've already seen stocks drop a bit. Are we going to see more of that?
Yep. I think we are. Look, you know as well as I do that this tends to be a seasonally kind of volatile, weak time of year, August into September, maybe even so much into October. I don't think the market's going to crash at all, but I would love to see the market back off, 7 or 8 or even 9%. Because remember, anything within a 10% range is well within the normal range of trading. The issue that I think we're going to find is as the market starts to back off, I don't think it's going to back off enough because there's a lot of portfolio managers that went to cash expecting the Morgan Stanley S&P 3000 call that never came. And so they're sitting there with plenty of cash that they have to now put to work. We're in the second half of the year. Markets are already up double digits, and these guys are lagging. So therefore, I think any dip is going to be bought. Unless, of course, the economic data should suddenly change so drastically that it would change the narrative, which I don't think it's going to do. So yes, I think the market is going to back off, but I don't think I'm not looking for a crash. If we move 6 or 7%, I'd love to see that. And we're already down. Well, the S&P is already down 4% from the highs 2 weeks ago.
Yes, exactly. We've seen kind of a rapid deceleration here. As always, I like to end with talking about your daily recipe. Today, it's another pasta one: pasta, zucchini, and guanciale.
Yes, guanciale. Yes, it's like the fat from the pig's cheek, right?
Yes.
But it's right now, if you don't have that, if you can't get it, you can always use bacon. But one way or the other, it's a simple recipe, and I put it in my note, right? You want to saute the guanciale first, make it nice and crispy, take it out, leave the fat that's left behind in the saute pan. Take your zucchini. I would use green and yellow because it's colorful, right? Cut them in half lengthwise and then cut them this way so you get like these half moon shapes. Put that right in with in the saute pan. Saute it up. The zucchini will make its own water, right? Boil the pasta, make it al dente. I would use penne rigate with this one, like kind of the short pasta. Then when the pasta's done, put it in with the zucchini, then add back the guanciale, toss in a couple of handfuls of pecorino romano cheese, toss it up and serve it immediately. It is delicious.
It sounds delicious, I gotta say, Kenny.
The whole thing takes you 20 minutes, start to finish, so it's also easy to prepare.
And I appreciate the last time you took a little bit of recipe advice from me, which was an honor, I have to say. And then you put out a recipe.
Yes, I did, and I actually gave you credit for letting me, think about that because it was perfect, right? It was your idea.
Thank you so much. I appreciate it. I don't have any inspiration for you today, I'm sorry to say, but I will next time. I'll know the pressure's on. Kenny Polcari, Kace Capital Advisors, managing partner. Great to see you as always.